Hey everyone, my name is Manu Kakkar from Kakkar CPA Professional Corporation. I'm here with Alex Ganny and Stan Chadrin from CPA Solutions. We're going to be giving you a short but sweet promotional video on golden oldie, we call it, which is shareholder loans. What we're going to be talking about as a minimum, and if we have more time, we'll be expanding on this topic. We'll be talking about shareholder loans, things you do not necessarily know because everyone thinks they know what it is. We're looking at creative offsets. When does a loan have to be repaid back, and creative ways to clear the loan? And if we have time, Alex has some goodies and surprises that he wants to spring on everyone. We'll just let you know. So we do work. We're from two different firms, but we work very closely together. And a lot of the stuff that we talk about are stuff that we deal with when we're dealing with other accounting firms, right? Because we service between the two firms. I've lost track of how many firms we service together collectively, other general practitioners. And this topic of a shareholder loan comes up pretty often. And what it is in a nutshell, everyone knows, is that if this provision didn't exist, right, your normal compensation from a company is a dividend or a salary. If this loan didn't exist to force a repayment of a shareholder loan back within a certain period of time, right, Stan and Alex, what everyone would do is just take loans out of the company and never repay it back. And then it would just be, we never have any personal tax, and then we'd be even more in debt because of COVID and because of the war or whatever it is than we already are. So that's sort of what the premise of the loan is. And we always deal with, typically clearing loans as dividends or salaries. But we're going to be talking about things of offsetting. And normally when you have an offset, it's like you take a shareholder loan and you offset it with a note payable with a dividend. When we're looking at creative offsets, and I want to hear, Stan and Alex's take on this. Let's say one company has a debit. Let's say ACO, and let's just say I'm the big spender here, right? Because I'm in Montreal. And, Montreal, it's a crazy lifestyle. We eat a lot and we drink a lot. And we don't save money. And let's say I have a company called ACO where I have a shareholder debit where I've taken money out of, let's say, $500,000, and I have a credit, or a company owes me $200,000. People would look at this and say, well, they're two different companies, ACO and BCO, and you're screwed. You have to basically clear a dividend in ACO, or you have to actually repay back BCO, right, of the 300, and then BCO has to loan 300 back to, like you have to do a round robin of checks, right? Or you know what I mean?
Manu,
So the other actually,
by the round robin, do you mean at the end of the day that if you're also the owner of company B, you would take the money out of company
that's
B
what I
and
meant.
repay
Sorry.
it back
That's what I meant to say. I did the round
to
wrong robin. You
yeah,
got me as always.
but you know
That's
what?
what I've wondered with the
Yeah,
cash. But
yeah,
I
with
need
the
the
cash,
cash.
you'd cycle the
You would
cash, and
cycle
then
the cash from
this is
BCO to you.
exactly
Yeah.
what you're saying. But I think that the
Let's say we
only
have no
problem,
cash.
yeah, then what happens? Like
That's my
cash is
question. I don't know.
yeah.
What do I do? So let's say
Ha-
there's no cash. What
yeah.
could we do? Because most
Yeah.
of the time in our clients, right, Stan and Alex, there is no cash. That was the problem. Because as you're
Yeah.
saying, you could just have Bico repay back Manu. Manu
Yeah.
takes the 300, repays back Aco. But what happens if that? Is there a way to offset in your experience without having cash? That's my question.
The only way that I know of, and I know this works, is you do a legal offset potentially, right? And
Right.
you hire you retain the service of a lawyer to do a legal offset
Right.
to make sure that you can actually legally offset it. It's interesting because you also like, and not that it may matter, but you always want to ensure that you're not doing something with the debt forgiveness rules or something like that. Stan, what are your thoughts on that?
Yeah, to answer your question, yeah, it is possible, right? You just have to make sure that the legal work is there, right? And you have to make sure that the loans are good, right? So the one issue that Alex mentioned, right, loan forgiveness, right? You have to make sure that these loans are actually in the money, right? So there is no issue with impairment of the
Mhm.
intercompany loans or anything like that. Anywhere in the system, right? So if it works and you document this properly, legally, right, with a good lawyer and everything is, legally valid, right? Then yeah, you can do the offset.
Yeah. And the only
Yeah.
thing I would add to that, sorry, you want to say something, Alex?
No,
Or
no, go ahead. Go
what
ahead.
I was going to say to that is that what ends up happening with the offset is that you just don't have to book the entries this way. The entries basically follow what the legal work will follow the entries. Is that what ends up happening is that, let's say in my company, where let's say I had BCO owing me as a payable 300,000. What ends up with the payable effectively gets converted back. The BCO will owe ACO $300,000. So you're basically offset. That's what the offset's doing. Is you're reconverting intercorporate. You're converting a shareholder debt, a debit or credit, on an individual basis into an intercorporate debit or credit, and that's something that I think a lot of lawyers miss. that you have to understand that you're obviously, that's what the offset is. You're offsetting the personal side to the corporate side. So you're creating an intercorporate loan of 300 grand. And that has to be part of what you were saying, Alex, about the legal implementation of it. And that's something a lot of times I see missed
Yeah,
because they don't
exactly.
understand where the offset, what you offsetting with.
Yeah, and that you bring up an interesting point with that, right? Because when you think about it, like I mean, you have to be very careful when you're doing things like that. You may end up in a situation where you could taint a company's QSBC status too.
Correct.
Well, because you may end up
That's a
creating
good
a
point.
bad asset, right? So you always have to think it through very well. Like this, it's not just that you just go, oh, today I can offset, right? You think, well, legally you can do this, but then what are the ramifications of doing this? Have you checked into the debt forgiveness rules? Have you checked into the QSBC rules? Like you have to do a complete whole analysis before you start offsetting shareholder debits. If the guy is planning on selling the company, does it make sense in doing it at that point, right? And you're creating a bad asset at the same time or something like that, right? So
Another thing that you definitely should consider is that, for example, it's a situation where you have banking governance, right? For example, I have a client who has a loan with real estate company, right? And they have some type of an arrangement where they say, okay, we will not request that realco to repay the loan that it has to the shareholders before the mortgage is settled or whatever.
Yeah.
Right.
That's normal. Yeah.
So then you have to be careful, right? Because you technically, reducing this debt, right? So you may be in violation of your covenants for loans, right? So you have to make sure that it works from a business perspective as well.
Yeah, yeah. It's just an interesting thing, like you said, is if you don't have cash in the system, it's something to consider. And you're right,
Oh, for sure.
like you do with everything else in tax, which you guys have both brought up, is that there are other factors you have to look at while doing something like this, especially with covenants and stuff, for sure.
Yeah.
All right, so I think we can move on to another thing you didn't know. Here, okay, guys, true or false? Here's a question, true or false question, and you know it's a loaded true or false question. Shareholder loans have to be repaid back within 2 balance sheet days, always. True or false?
Well, Stan, do you want to answer this? Because I think we had a big, long discussion on this, and you had some points on this.
And it's a loaded question because that's what most account at stake. They say 2 balance sheet dates are
And
repaid back.
technically,
So
I don't think
in all cases, true or false. I'm just using the word in all cases. Okay, Stat, you answered this. In all cases, true or false, does it have to be paid back within 2 balance sheet dates? In all cases.
I was going to say it depends, but there is no such option. So if those 2 balance sheet dates are within...
That was my answer. That's my answer. Yes, okay. Yes,
so if
yes,
those 2 balance sheet dates are within 12 months, right, or exactly calendar year, yeah, that's true. If not, it's not true, right? So the actual rule is, calendar year, right?
Yeah. So let's give a really easy example. Let's say we have a normal calendar year end of a company, let's say December, right? So let's say my company again, Kakkar CPA Professional Corporation has a December year end. That's what it has. So let's say for some stupid reason I decide to amalgamate September 1st. So I have a deemed year end August 31st, right? And then as we're allowed to choose a new year end within 53 weeks of the old year end. So because let's say I screwed up and I amalgamated, I say, oh geez, I amalgamated. My dad's going to kill me. I'm going to basically re-put the date back to December. So now I had a shareholder debit balance in August. Does that debit in that case have to repeat? Because if what we think, normally most accountants say, yes, you have 2 taxation years, 2 balance sheet dates. I have 2 balance sheet dates, August 31st, 22, and December 31st, 22. Does it have to be repaid back by December 31st, 22, or another date? Let's say in that example, Stan or Alex, what would you say? Does that yes, it has to be repaid back by December 31st, 22, or no, it's another example? So remember, amalgamation September 1, then I re-choose another year on December 31st.
Oh wow, we've
the loan,
and I had the debit as of August 31st. The loan was
on August 31st. I would say you have to repay it within 12 months.
Yeah,
you're correct.
That's exactly what I thought too.
That's and the issue is, you guys are smarter than me, and not only better, you're better looking than me. The issue is as simple as that I had thought always that you have 2 taxation years. But like you're right, in 15.2.6, I believe it says, we were doing something and there was a technical call that someone brought up, is like you're right, that it's 1 year from the end of the year in which the debt was there. And sorry, Stan, you're right. I was saying as of August 31st. So it says 1 year. And if you go to 35 sub 1 of the Interpretations Act, they say 1 year is always 12 calendar months or 365 days. So Stan is correct. In that case, it would be 12 months or 365 days from August 31st, 22, which means I have until August 31st, 23, even though my year end is a December 22. So it's not exactly clean cut. One of my whole point of that exercise was if you have funky reorgs or you have something going on which cuts the year end normally you have a regular year end where you see it. Okay, it's the following year, 2 balance sheet dates. But this is just a funky example. That is not the rule. It's within 1 year of the day in which the year end in which the debt was incurred. I thought that was funky. I know that, Stan, because you know everything. You said yes, I'd seen that before. But I just think most accountants, I know we were talking internally, I think a lot of accountants, myself included for the longest time, was mistaken. I'm just curious to hear your thoughts about that. Like what sort of tips or traps would you look about when to repay back the shareholder loan? Because it's not necessarily clear cut by looking at balance sheet dates. I don't know if you guys have any other, because I know you
No,
guys
for
deal
sure.
a lot
I
with
mean,
this work
you
as
have
well.
to actually look at the GL and see when the problem arose, and I think you have to go from that point on, and then you have to work it back into the legislation and figure it out from that point, right? You can't just rely on a balance sheet date, right? Because that's not what CRA will rely on in the context of an audit, I think, right?
I'm just curious, will even CRA know the rule?
Well, I mean, whether
That's an interesting question. I'm just
Yeah.
wondering if they would know this.
I mean,
'Cause I'm just curious.
it
Maybe
is
they
the
would.
law, right? Whether an auditor does apply that is a different story, right? You know, the law is pretty straightforward. It's from the point that it was incurred, I think, right? So
No,
yeah,
it's clear.
yeah,
I agree with you.
yeah,
Now, when I read it, I think it's
yeah.
really clear. I'm just saying, would your opinion, because you guys deal with accounts as well, would you think that there's a
Oh, for
misconception
sure.
out there?
Yeah,
Yeah.
for sure.
You think so?
I
That's all.
agree
I'm wondering.
100%. There is a misconception because how many times have I gone an account and say, well, you know, it's not on the second balance sheet. Well, that's not really the case, right? You know,
Yeah,
right?
yeah,
So
yeah.
so that is definitely a misconception, and I think if you have such a situation, that it's always good to get to read through the legislation and try to analyze the shareholder loan a bit more before you start making a determination, because you may have had a problem, and then that leads to the point that, you know, is there deemed interest inclusion as well under Section 80, right? In respect to
Yeah,
that, and I know CRA has picked up on that at times,
yeah,
right? So, you know, if
yeah.
they really want to go after you, then they will go through the deemed interest inclusion issues, right? I mean, the question really on that side is how many accountants bring that up too, right? How many accountants actually report that, right? Because that is a fundamental thing that
My dad
yeah, your
does.
dad, this is what your dad's a good accountant, but your dad knows the rule. But a lot of times I've seen accountants just miss that, right? And CRA come in and assess it on the shareholder.
Or
Yeah,
purposely or they say they miss it, but they really
yeah,
didn't miss it. But
exactly.
anyways, but another misconception I find is people don't understand. They say, "Yeah, but I'm repaying it back within the
Yeah,
year, right?" As Stan said, do I still have to include the interest benefit because I'm repaying it back? And the answer is
Yeah, you
technically
yeah,
definitely
yes.
do.
You do. It's not. It's one or the other. People say, "Well, I've repaid it back." But I go, "It doesn't matter. The loan's outstanding. You have a benefit. You have to
yeah,
take it. You have to take it out." So if it's outstanding more than, let's say, the current balance sheet date, I don't think most accountants do an 80.4 interest
nope,
benefit and T4A it.
yeah,
That's what I've seen. I don't think most people
no.
do it. So, is there anything else you want to add, Stan, on this point, or not really?
Well,
Or
this
you're good?
misconception about the interest, it goes in even further. I don't know how many discussions I had with the accountants who are saying, "Oh, but we are paying interest, market interest rate on the loan. Why do I need to repay it? It's not a shareholder benefit, right?" I don't know how many times I heard that
That's a very good
argument,
point.
right? And the unfortunate reality is
Yeah,
that
I've heard it too.
it has nothing to do with
Well,
market
that's
interest rate, right? So,
yeah.
It doesn't fall into the exceptions of not repaying it back. Like you're not a mortgage lender, you're not
exactly.
going to
Yeah.
quash shareholder, which I know Alex was
Well,
talking
yeah,
about, and
that's an
whatever.
interesting
Yeah,
point too, right? When you think about it, because how many times
yeah.
do we see people trying to take out a shareholder housing loan,
Yeah.
right, or the employee housing loan, right? And they're like, oh well, you know
Those
what?
are
I'm
dangerous.
paying it back, and I find that's extremely dangerous. And you know, you're asking for CRA to come in and ask for assess a benefit, because their CRA's default position in that particular case will always be that you took it out in your capacity as a shareholder, not as an employee, right? You know,
Especially if there's only one shareholder employee of the company and they
Yeah.
take a housing
exactly.
loan, right? So
Yeah, I mean,
that I've seen. Yeah,
yeah,
that doesn't
wouldn't
work,
it
right?
not be
Yeah,
better
exactly.
just to do a potential surplus trip at that point and take the cash out and pay it, then live with that CRA audit risk and then try to pay the interest back and deal with all that headache, right? You know, just take the money out if the shareholder needs the money personally, right?
So Alex, you're my Ed McMahon and I'm the Johnny Carson. You just led
Yeah,
into
exactly.
something really interesting. Let's say you have a shareholder debit. Let's say you have a shareholder debit. Okay, popular misconception. Is this true or false? Let's ask Alex the question. True or false? The only way always to declare a shareholder debit is through a salary or dividend. True or
False.
false? In all cases.
Well,
Why?
I
So
mean, you
why do
can
you
do
say
a surplus
false?
strip and take care of that too, right?
Yeah. And so what is a surplus strip? Guys, let's say no one knows what a surplus strip. What is a surplus strip? And
Yeah.
like high level, how
Well,
would
I
that work?
mean,
Like without obviously we can't
yeah.
go over the whole details, but
Well,
obviously high
that's
level
the
could work.
as most people are aware, there are three different the three or four different tax rates in Canada, right? One is the employment income tax rate. The other one is essentially which is taxed at the highest rate in Ontario, at least at 54%, right? And then there's the dividend tax rate, which can be anywhere from 39.34% to 47.72%, right, in Canada. And the third amount is a capital gains rate. So the whole idea behind a surplus strip is to try to take that cash out at the 26.76% rate
Right.
and mitigate the tax on it, right? I mean, it requires a series of transactions to enter into to do it, and then you
Sure.
have to take some legal steps to do it. And at this
Sure.
point in time, in this day and age, today on March 4th, it's still allowable. Whether it
Yeah.
remains allowable is a different story. But C208
We'll
coming out,
see if when the next
right?
budget comes.
Yeah,
Well,
the budget.
the budget coming.
Exactly,
Yeah.
right? And I think the
Yeah.
consultations have
Yeah.
ended
Yeah.
now on the budget. So it should be coming out soon,
Yeah.
right?
I hope so. They haven't announced it. I don't think they've
No,
announced it as
the
of today.
budget
Have they?
hasn't
I
been
haven't.
announced as of today, but you never know when that's going to come, right? They're going to give you a week's notice,
Yeah.
right? So
Yeah, it'll be either March or April. It was
exactly.
in tax season.
Mhm.
But so that's another way to do it, and it's just another thing I just wanted to mention that you have surplus stripping options to clear shareholder debits as well. It's not as straightforward as you look at it. That's why we're trying to explain the whole purpose of this little tax talk is to show, look, guys, you have a shareholder debit. There could be planning opportunities with it, and like Stan said, also with offsets, you have to watch out for the planning opportunities to see if there's other things in play. But we're just trying to say that there are a lot of planning opportunities out for it. Whatever you look at, you have to look hard enough. Alex, do you want to say something else about
No,
shareholder
I mean,
loans or anything else you want to add at this
the
point? Just
big
for
thing
closing, what do you
we see
think?
is the qua employee argument, but I don't think that works, right? There's some other interesting. There was a court case that came out where a shareholder tried to put his son's wedding through the business, alleging that oh well, it's all business.
There's a
Yeah, it's
promotional
all
expense.
business related, and all. CRA went and slammed him with 163(2) penalty. So don't do something silly like that. Yeah.
I've heard of that. I saw
Yeah,
someone
and
do
it's
that actually.
dangerous.
They were fighting the same issue. It wasn't that court case, but it was someone else, and he argued that only people invited were all his business clients,
And
that was all there.
I think
That
that's
was
a
all.
losing argument. It's a loser at the end of the day, right? I mean, but you also have to remember that there is Addis and Nigel Hill, in which the CRA argued that these advances should have been income, but the accountant was declaring dividends to clean it up, and that was acceptable by the courts, right? At the end of the day, and CRA accepted that position in IT 119 R4, right? And this series of other views documents, which if you guys want, we can, if anyone listening wants those views documents, feel free to contact us and we can definitely share them with you. Yeah.
Basically, Alex is trying to say politely, if you can't fall asleep at night, Alex will let you send it to them so you can fall asleep. That's what my wife does. She reads the income tax, actually falls asleep. She doesn't take any sleep.
Right.
That's what my wife
And
does.
then
For the last
and
20
then you
years.
also have to be aware of all the non-resident shareholder issues, right? Yeah.
Oh, that's very good.
Yeah.
And
So,
Stan here likes non-resident. That's actually
yeah,
very
like,
good. Why don't you
what
go into
happens
a
if a
non-resident issue?
non-resident
That's a very
borrows
good
and
idea.
they're not taxable in Canada? Well, are there provisions in the Income Tax Act to stop such a thing? Stan, do you want to take
Yeah,
that on?
that's actually very.
Let's go for another
An
hour.
hour
now.
would
I'm
not
just
be
kidding. Go
enough
ahead. Yes.
for that
Go.
topic. Non-residents, I really like those.
High level stat. Let go over it because that's a very good point. Is that you have a non-resident Canadian company, non-resident. Let's
Yeah.
make it an individual. Even make it simple. What other issues? Or you want to make it a corporation stat? You want to make it easy better if we make it a corporation so you can worry about employee and all that. Anyways, why don't you
Let's
make it subsidiary?
Can we make it just
Canadian
general?
subsidiary?
I'm just going to throw in one thing, which is withholding.
Go ahead.
Right. So withholding is a big issue, right? What happens if you have a shareholder loan outstanding for longer than a year? The exception does not apply, and so on and so forth. So the issue with a non-resident is always the withholding tax, right? And the issue with the withholding tax is not only, okay, you're liable for withholding tax, but then what happens if the loan is repaid, right? So what do you do with the withholding tax that was remitted, right? and there is this whole procedure of getting it back. It's extremely long, right? It takes years to get back, or at least like that. That's my experience how it works. So it makes things extremely difficult, right? For the
Isn't there a 2-year window or
that's the
something?
deadline
You have
for the
to make
application, but
within
then you
2
have
years to get it back.
But then
That's
you
for the
have to wait a
application.
number of
Oh yeah,
years,
it takes
right,
years.
for CRA to process it, right? Especially if you're
Yeah.
into some type of a complex situation where you have, like it's easy when the money is loaned to the shareholder, right? But what happens if the money are loaned to another company, right? That is also in a related group,
In the related
right?
group.
Or to
In
a
a related
partnership,
group.
right?
Yeah.
Or if you not even that. Let's take it even a step further, right? What if the company participates in a so-called cash pooling, notional cash pooling arrangement, right? They are called. So effectively, the company doesn't even give the money to a related group. It gives the money to the bank, and then bank uses this as sort of like collateral to provide liquidity to the other. That is also a shareholder loan. So these non-resident rules, they are extremely complicated, right? So, and even when you identify it, right? So say you have a notional cash pooling arrangement, right? So what is your withholding tax rate? And that question is, $1 million question. I've seen, Excel spreadsheets that are, I don't know how many lines are there trying to calculate those withholding tax rates. So with non-residents, things get a lot more complicated.
100%.
Yeah, and I will throw one last point. Let's throw non-resident. Stan was talking about the Canadian sub loaning to a non-resident related person or sub. But here's another question. What happens if I have me again? I'm using me as an example because I don't know what I'm doing. I invest in a company in India. I'm a resident here in Canada. I invest in a company in India, and I have a shareholder debit from India. Forget about the Indian tax consequences, because as we know, Alex, we're from that part of the world. Indian people don't pay tax anyways. It doesn't really matter. But let's say they don't. They think tax is a bribe, but that's another issue. That's fine. But let's just say we have I'm investing in an Indian company. I'm the only shareholder. Forget about 1134s. Forget about all that stuff, which is relevant. Do I have a shareholder loan issue if I invest in a foreign company from a Canadian perspective? Yes or no?
When you look into the shareholder debt rules, right? Nowhere it limits the situation to a Canadian company. Right?
That's right.
Correct.
Yeah, the reason I mention that, my friends, is because most accountants, I believe, I could be wrong, think it only is relevant to Canadian companies, or they don't think, they're not reading 15.2 and they're right. It doesn't say corporation resident in Canada. I know that's why you were looking at the Act, but they don't realize it could apply to upstream loans or, let's say, related party non-resident loans from a Canadian company, because you have connected tests under 15.2.1 and all that. Or like you said, Stat, is that it could apply if I'm a Canadian getting a shareholder debit from an Indian. Now, I've seen it. It's rare, but I have seen it. And when you go to the client and say, forget about the Indian tax consequence in my example, you have a shareholder debit issue, you have 15.2, and they're like, what are you talking about? It's not a Canadian company. I go, that's irrelevant. I'm just trying to say that these rules are not, they're more international based than you think there are. They could apply on an outbound international debit. It could apply on an inbound. It could be all sorts of things going on. It's not simply, Canadian. The only simple exception we all know, and I'll close on something from a sanity perspective, intercorporate loans. If there's an upstream loan from parent to sub, is there a shareholder debit problem there? Canadian company, both Canadian. Upstream loan, Canadian sub to Canadian parent. There's an intercorporate loan receivable. Do we care about shareholder debit? The answer is
your alley, man.
Well, it's all domestic.
No, it's all domestic. It's domestic. Come on, it's all domestic. It's all domestic.
It's all in there.
Alex is like, it's all domestic. We don't care.
Yeah, there is an exception in 15.
No, I'm not talking international.
But then, if it's between two Canadian companies, yes, that's true.
Yeah.
That's all I'm saying.
Yeah.
I'm not saying anything with partnerships. I mean, the rules gave it more complex when you have a loan to a partnership.
Yeah.
When you have a loan to a trust, right? With the Gillette case, the loan to the partnership gets caught. Loan to a trust. People were loaning money to a trust, and they say, the trust is a shareholder, but not the individuals. And of course you're caught because there's a finality rule that connects your trust to the shareholders. So I'm saying you have to be really careful with this. This is not as straightforward as you think it is. And the issue is that, like, and in closing, like I said, we've seen this, and you can tell, like, this is not stuff we're inventing. We're all looking at each other. This is stuff you see. that it's the fact pattern that keeps changing. And if we keep throwing things, and I keep doing this. Obviously, Stan and Alex are very seasoned tax practitioners. They're very experienced. They know they're all looking and but they're understanding what I'm going with. I'm just keep changing little facts, and like Stan and Alex are reflexively looking back at the act. That's what you have to do, because it's not every time you change a little fact, it's not so simple anymore, right? And these things we've seen. People have said that loans to partnerships, shareholder loans to partnerships used to be exempt, but then they got caught and they changed the rule on that. The trusts were changed, and this is where people don't understand is that these were all loopholes that have been closed off. So anytime you look at any kind of shareholder loan, whether it's to a corp, except if it's an intercorporate Canadian corp, but if it's the foreign corps, foreign parents, foreign related persons, outbound, inbound, trusts, whatever, and there's a connection with a family anywhere in there, or there's a controlled group in there, you got to think about these rules and start looking like Stan was looking at the act. He was flipping through, looking,
Oh, sure.
and like Alex, like you have to go back to the legislation. Yeah. That's what Alex says all the time. Go back to the legislation. Don't just look at memory, because every time, I don't know about you guys, and I'll close on this, like everyone says, oh, Manu, you know so much about tax. I say to people, every day I realize I know more and more about absolutely nothing in tax. I realize every day I know more, I know less and less. There's so little we know. At least I know. You guys are smarter than me. I realize so much I don't know.
Without a doubt.
And I'm never going to know.
You can never know everything, because the situations can be so unique.
On closing, listen, I want to just leave it to you guys. I've said what I wanted to say. Do you guys have anything closing thoughts? So I want Alex and Stan, and I think it's been a nice talk. And like Stan said, on the international loan, he can go on, forget about for 20 minutes. He can go on for 20 hours. That's a topic on itself. Now, don't give Stan any ideas. We don't want him to go for 20 hours at this point. But I'm just saying that, do you guys, Alex and Stan, you want to close on what you want to say? Like, what do you have to say to everyone out there, the accounting practitioners?
No, in closing, I think, like I want to generally say that shareholder loans can be very dangerous, and you have to be very careful with them. And the rules themselves, though they seem simple up front, are very, very technical, and without you knowing it, you could get caught offside very easily. So it's always important to analyze them closely and make sure that there is no fundamental issue with your loans, right? So it's a very dangerous game to play, and it's high on CRA's radar as far as I'm concerned, and you have to be careful. Stan, you?
Yeah, well, my concluding comment is that think about it in advance, right? If you catch the situation before the end of the year, there is something you can do, right? You can reach out to us or any other tax consultants who can help you manage the loan. But if you think that you can manage it after the fact when you prepare the tax returns, likely it's not going to happen. Or if it's going to happen, there will be some, losses in terms of taxes payable and stuff like that, right? So think about it. Don't leave it hanging. Take proactive steps to address the issue.
Yeah, and listen, guys, thank you very much. Alex, thank you very much
You're
for your
very
time.
welcome.
Stan, thank you very much for your time. Ajag, thanks very much for having us here. And if there's anything, let us know. But we just took this topic. It was 20 or whatever. It was 30 minutes. We wanted to just blow it up. And the reason why we did it in this format, we've gotten really good comments. I know the three of us have presented before for Ajag that they love the fact of presenting. And this is what we do in practice. We talk. This is why we do tax. This is how we practice. This is how we look at things. And we figured this was a lot more interactive, and hopefully it works. This will be, and look forward to our presentations. We're not doing it on shareholder loans, but the two groups, CP Solutions and Kakkar CP Professional Corporation, are doing 4 presentations for AJAG in the fall. We look forward to seeing you in those presentations. So thanks a lot, guys. We appreciate it.